Hello and welcome everyone to the week ahead commodity report for the 24th to the 28th of June, presented by myself, Phil Carr, at the Gold and Silver Club. So what do you need to know for the week ahead? So first of all, we have seen gold prices break out here to 6-year highs on Friday, surpassing $1,400 per ounce, posting the biggest weekly gain since April of 2016. We've seen that as a result of the dovishness from the Federal Reserve, geopolitical tensions in the Middle East giving strong support to the yellow metal. Also, the Federal Reserve earlier on this week said it was ready to battle growing global economic risks, hinting at a rate cut beginning as early as next month. We've also seen oil futures rise over 1% on Friday, but over 10% in the latest week. Wti Crude Oil breaking out 10%, which is the biggest weekly gain since December of 2016, and Brent crude oil gaining 5% on fears that the United States could attack Iran and disrupt flows from the Middle East, which provides more than a fifth of the world's oil output. Hedge funds and money managers, they have also boosted their positions in COMEX gold in the latest week. They have switched to a net long position in silver futures and raised their bullish positions on US crude oil in the latest week. So with that, let's move over to the charts and we'll talk you through the major levels that we're looking at as we go into next week. Now, gold was exactly as we mentioned last week on the week ahead commodity report, that the majority of technical traders out there were looking at this rejection, the inability for gold to close above $1,350 per ounce. They would have been triggered on this breakdown below the daily highs here as we started to see a reversal. 70% of retail traders were net sell short. However, hedge funds and money managers, they had accumulated their largest net long position in over 1 year. We've been mentioning that now on the last 3 commodity reports, that you really wanted to watch out what the smart money is doing on this market. Our in-house intelligence on our research-driven approach had identified that overall hedge funds had continued to accumulate their net long position versus the retail trader, where over 70% were selling short, and often retail traders are on the wrong side of the move, and you cannot rely purely on technical trading. You really need to take a research-driven approach to the markets to give you an edge. So with that, a lot of the technical traders, they got liquidated on that breakout to the upside for gold here once it broke above $1,350 per ounce with a lot of volume. As we mentioned, the FOMC statements are catalysts for really explosive moves in the market. Since that FOMC statement, gold broke out more than $70 to the upside over a 700-point move that we've seen there, breaking all the way out to resistance at $1,411 and closing just below $1,400 to end the week here. So if you have a look at the weekly chart as well, we've blasted above a lot of that resistance again, where technical traders were looking to sell into the highs here, whereas hedge funds and money managers accumulated the largest position in over a year to the long side. So we've now blasted above all of that resistance, taking us up to now 6-year highs. As we go into next week, the next key levels of resistance are of course the 1411 zone, which got tapped there on Friday. Above that, we've then got the next major level overhead at $1,433 per ounce. We'll be keeping you updated with respect to the ranges and our trading plan as we go into next week for gold on gold asset of the day on Tuesday. So make sure you look out for that as well. But this has really played out exactly as we mentioned last week, that you wanted to be very careful, that most technical traders were looking at this as an opportunity to sell into gold. It was absolutely not the move that you want to be looking at. You wanted to be looking at what the smart money is doing in this market. And essentially that has been to buy. And you've seen this reversal in the market, which has not played out at all. We've just seen a lot of those retail traders get liquidated on the move to the upside. But I hope you didn't. I hope you capitalized on that breakout, or at least you caught it via some of the correlations as well. So for example, either platinum or silver, or you've caught the breakout on oil there, which then leads me over to platinum, because platinum, I mentioned last week that I was looking for another retracement back sub $800 in order to get long. We got that level early in the week on Monday, executed a long position at $792 per ounce. In fact, we hit our profit target automatically after the FOMC statement there for 300 points. That worked out. Really nice breakout trade that we caught there on platinum to the upside. So now as we go into next week, you can see where we've been consolidating again around the $800 per ounce level. The cycle at the moment has tended to be the metals can weaken a bit from the beginning of the week and then pick up momentum later on in the week. We've got the G20 next week. We want to watch out as well for geopolitical risk between the US and Iran at the moment as potential safe haven bids, particularly for gold. But we'll be watching again to see if platinum can roll over, get back below sub $800, and then look at evidence of buyers to come back in and essentially look to capitalize on another breakout. If you look at the weekly chart there, we've been consolidating for quite a while on platinum, very similar to what we saw back in January and February of 2019 before we then had over 1,000-point move to the upside. So platinum is still very much on the radar now for a re-entry after we banked 300 points following on from the FOMC statement. Now moving over to silver, as I mentioned last week, hedge funds and money managers, they've now started to switch to a net long position. Again, from a technical point of view, a lot of traders were selling into this move at the beginning of last week. They saw that rejection. They were looking for more follow through to the downside for silver within a bear flag formation, but you needed to bear in mind that gold was leading the move. Silver correlated to gold will often start to catch up to the price action with gold, and as such we have seen again hedge funds that bought into silver in the latest week. We've seen a breakout above the weekly highs. Overall, silver has moved so far this month. It's up 5.4% in June. In the week, it's up 3.6%. If you have a look at the weekly here, we've now broken out of this downward trending channel, so we're starting to build up some decent momentum to the upside here. We had a pullback last week which did not break down at all. We continue to see follow through after the FOMC statement as well. We're trading at $15.33 per ounce. This is absolutely on the radar as we go into next week, so I am looking for the potential to get into pullbacks as buy opportunities, but I am keeping a very close eye on news feeds, what's going to happen with the G20 as we go into next week. Short term, we are a little bit overbought at the moment, so we'll be looking to see if we do get a further dip here at the beginning of next week, and we'll be looking for evidence of buyers coming in on any pullbacks there as well. And I would absolutely have your eye too on platinum, and of course keep an eye on oil here as we go into next week if we do see an escalation in geopolitical risk between Iran and the United States. We in fact initiated a new long position on Brent crude oil last week after the FOMC statement. That position is now up over 350 points into the close here on Friday, and we've continued to see that strong momentum follow through throughout the week after Wednesday's drawdown in oil inventories, and that provided some support midweek. So with that, we've seen some significant follow through over the last few days. I do hope some of you capitalized on these breakouts that we've seen here on oil. We mentioned this previously. If I just go back to WTI crude oil, you've essentially got this very important level around that $50 per barrel handle, which was respected. We've springboarded off that layer of support, and we've seen good follow through later on in the week after the FOMC statement, and in fact a further breakout here after a US military drone was shot down and Donald Trump then threatening to retaliate. So if we just go over to the weekly chart for WTI crude oil, you can see here we've had this breakout back above last week's highs. We tapped that lower end of support around the $50 per barrel handle for the last couple of weeks. Surged last week after the FOMC statement, broken above the weekly highs. We've essentially come back up towards the next major layer of resistance, which resides around $58 per barrel. So what I would look out for next week, we do maintain our long position and we're keeping this on as we go into next week with a stop loss protected on Brent crude oil. The remainder of the trade is up 350 points. So ideally we're looking for a bit more follow through as we go into next week, breaking above the weekly highs now around the 58 level and then taking us back out towards $60 per barrel for WTI crude oil. If you don't have a position at the moment and you're looking to get in on oil, I would actually have a look at Brent crude oil going into next week. So potentially if we were to see some profit taking or a pullback, we do have the G20 meeting next week as well, by the way. So if, for example, we get any negative narratives about the US and China with respect to trade tariffs, what you could see is a potential for a pullback on oil. And if we do come back towards that $64 per barrel level for Brent crude oil, I would look then for evidence of buyers to come back in and the potential to then take it back towards that recent swing high. If you have a look at that on the weekly, very similar to WTI crude oil, we've broken back above the weekly highs and some decent follow through there later on in the week. So with that, we've got a bullish bias on oil going into next week. Do note too that hedge funds and money managers, they have now started to buy back into oil. We had seen several weeks of reduction in the overall net longs. We've now this week started to see funds buy back in to crude oil. As I've mentioned before, when you're trading, you really want to make sure you have an edge in the markets, and this is where a research-driven approach will give you that edge. You have access to market sentiment, trade flow. You're marrying that up with what retail traders are doing versus what the smart money, what the hedge funds and money managers are doing in terms of their positioning. You combine that with fundamentals and then technicals, and you're able to generate trade ideas which give you an edge. So with that, to find out more about our research-driven approach, there is an opportunity for you to join us at the Gold and Silver Club. As a member of the Gold and Silver Club, you learn a research-driven approach to your trading. You have access to our exclusive live trading room webinars, access to real-time trade alerts, trading research and market insights, access to our private members academy membership site, and also support and one-to-one mentoring. For more information about the service, just go to www.jointhelivetradingroom.com. The link is also below this report in the description. So just click on the link, make an application, and we will of course get in touch with you ASAP, and make sure you subscribe to our YouTube channel. That way you're always kept updated with all of the latest commodity reports.